Broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Thank you all so much for joining us today for our quarterly webinar series titled CIO's Corner. It's a quarterly update with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Murray, and I am the Client Service Associate for Stonehearth Capital Management. I have been with Stonehearth for 3 years, and my primary role includes client service, marketing, and compliance. I'm happy to assist Chris this year with his quarterly update webinars. I would like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of the questions and will ask Chris to answer as many as he can at the end of the webinar. If we run low on time and are unable to get to your question, Chris or myself will reach out to you directly to make sure we can get your question answered. Now I would like to introduce our speaker for today. Chris is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk research, and portfolio management functions. Thank you so much for speaking to us today, Chris.
Thank you, Amanda, and welcome everybody from another beautiful day here in Massachusetts. Looking out my window, it's a little rainy here, so I'm still waiting for that summer/spring weather to come, so hopefully we'll get some pretty soon. So what we want to jump into, let's jump in to start with what we're going to go over today. So what we're going to cover today is what we've done before in our past webinars. Is we're going to go over historical asset class performance, what's happened over the past quarter, the past year, see what's working, what's not working. We usually don't like to focus here too much on the short term, but we do think the past is a pretty good guide of what's going to happen in the future, and it kind of helps to know where you've been, to know where you're going. Then we're going to talk a lot about the investment environment, what we're seeing out there. As most of you are aware, that we have a multi-factor risk model that we use to judge the current investment environment. We are observing risk, not predicting it. And we're going to talk a little bit about thunderstorms and hurricanes. And what we mean by thunderstorms and hurricanes is, with what's happening in the market, is it leaving a permanent damage on your portfolio, like a hurricane does when it comes through, wipes out houses, changes the landscape, and there's a permanent damage to your portfolio? Or is it a thunderstorm? It's loud, it's noisy, but it's passing. And once it passes, there's not long-lasting damage to anybody's property. And we're going to do this in terms of what is happening to your portfolio. Is the current market environment a hurricane to your portfolio, or just a thunderstorm and it will pass? And then with that, once we decide that, we're going to talk about where we're positioned in our portfolios, what we are seeing in the market, what we're taking advantage of, and what we're seeing is, maybe getting a little risky and we should be lightening up on it. And then to close it out, before we go to questions, we're going to talk a little bit about our carbon light portfolio and its a solution. And this basically arose from our last webinar where I mentioned it in passing, and we got a lot of feedback where people would like to know a little bit more about it. So let's go into what's happened. So we're looking at Q1 performance here. As always, commodities are in yellow, international is in green, US is in blue, diversified portfolios in red, and purple for fixed income. So it's kind of misgiving, because what we've seen performance lately is we've seen this really negative performance in the past month or so, and everybody's really feeling negative about the markets. But again, that's due to recency bias. We kind of forget how this year started off, and started off on a very positive note. The S&P was up over 6%. So when you take that positive January, negative February and March, we end up with a pretty much flat market in the US equity market. What we did see was very strong performance from international EM and oil markets. So again, a lot of that had to do with the weak dollar. And what was interesting is we didn't really see this flight to safety in the sell-off. So with the S&P down 70, you would expect kind of fixed income to do well. We didn't see that. When we look over here in the purple, we see munis down over 1%. Corporate bonds almost down 3%. Long-term treasuries, which is going out the 30-year on the curve, down almost over 3%. So historically what we've seen is that when equities kind of fall out of bed or kind of fall off, that we see these fixed income instruments outperform. We're not seeing that again. We saw other assets outperform. Frontier markets, emerging markets. We saw a little bit push up in gold and a lot in oil. Oil was really due to more idiosyncratic risk and more about geopolitical in terms of Syria. And really what we saw in this quarter was investors reacting to a lot of rhetoric out in the market. And again, this goes to that thunderstorms, hurricane scenario that we're talking about here in the analogy. And really with seeing a thunderstorm, it's a lot of rhetoric and what I call the 3 T's: Trump, tariffs, and trade wars. And it's not a comment on what's happening in the market, or it's not an opinion, it's what's happening, what investors are reacting to, and they're reacting to a lot of rhetoric. And when we go forward and look at the risk environment, we'll look at the data and say the data is not matching the rhetoric right now. We're really seeing a pretty decent market for risk assets. Going on a little bit longer, I'm looking at a 1-year performance as of March 2018. We really see a more traditional asset class chart performance here, where we see momentum. When we see momentum, we think FANG. When we see FANG, we think Facebook, Netflix. We think Alphabet, formerly known as Google. A lot of those stocks that have performed well for the past 3 years continue to perform well over the past year, and we see that. We don't think that continues. We are a little nervous on the FANG stocks. We don't own many of them in our individual stock portfolio, and we do think momentum is, while it's been one of the best performing asset classes coming into this quarter, it may not be going forward. Still like Frontier and Emerging, we're seeing international really start to take over the lead from the US. For many years now, we've seen the US kind of lead everybody, where we're seeing winds of that changing in frontier markets, emerging markets. Again, oil has had a great run here, but again, we have to remember, only a few years ago, oil was at $100 a barrel. It's only about 60 now. So even though it's had this great run, it really came off a cliff there. So again, it's just kind of recovering a little bit of what that fall off happened. Look in terms of negative performance, there wasn't much out there over the past year, which is very good news for investors. Managed futures, alternatives are struggling in this environment. The dollar, like I said, we talked about this weak dollar environment. MLPs, a lot has to do with the weak dollar and also the new tax law passed by Congress. We also saw a negative performance in REITs, which we don't track here on this chart. But other than that, it was really a pretty strong 1-year performance across the board. So investors are really pretty happy. And when we look at what that typical investor gets, that moderate investor, that average investor, if you'd say, they gained about 10%. So again, most investors, irregardless of what happened over the past 2 months, if they look out over the past year, they're pretty happy with what they've seen in terms of performance. That's kind of where we've been. And then now that we know where we've been, let's kind of take a look at where we are and where we may be going. So this is our Stonehearth capital market risk model. This is done internally by me. We created this about 5 years ago now, going on 5 years, almost 6 years. And what it is designed to do is to take a multiple factor framework and identify how much risk is in the market, so we can help adjust client portfolios to take advantage of risk or defend against risk. And that's that preserve, protect, and grow mantra that we talk about a lot here at Stonehearth Capital Management, that there are certain times in the market that you need to preserve what you've gained. You need to really protect what you've gained. That's that hurricane. You really need to protect what you've earned. And there are also times where you need to grow and really want to take advantage of risk in the market. So we use a multiple lens framework. We basically have 4 factors: technical, valuation, macro, and qualitative. I broke out the technical because it just looks better on a presentation and it kind of gives you an idea of where we're going and what we've been. Again, like I've mentioned before, we're observing risk, not predicting. This is not intended to say where risk is going to be. This is taking a look at all the factors that we know that have an influence on the market and saying, giving the entire framework, the entire picture, where do we stand on a risk schedule? So look at the technical. We have 2 versions of it: structure and reversion. Structure is basically, how's the market behaving? What's out there? Are the right sectors performing in strong investor sentiment? Reversion, we're looking for turning points. Historically, certain factors have indicated that there may be a turning point in the market that's been rising for a while and may fall. Also, the other way, on a market that's been falling, it may indicate when the market's about to turn and go up. Valuation, pretty straightforward. The strongest market returns we've seen are when markets are cheap. The weakest returns we've seen are when markets are expensive. Macroeconomic factors, they influence the market. They influence what companies can earn. They influence the investment environment and have a good indicator of what's going to happen for the next 5-10 years. And qualitative, like anything, we bring over 20 years of investment experience and we bring this experience to bear and to judge, to make sure that we don't just run off the side of the road because the computer said to, the GPS told us to. We really want to take a conscious effort and make sure that we have the right risks in the right portfolio. So when we look at this, we look at the technical picture, and again, we saw a very deterioration of the technical picture across the market. We did not see a break in the technical picture, and we'll kind of go through a few indicators that show this, that while it's weakened, it is not broken yet. Valuation, since I've been here, I've not seen a positive reasoning on valuation, and I started here in 2012. The market's been overvalued since 2012 based on the indicators that we use, and it hasn't changed. It's got a little bit better, and the big piece that kind of drove that a little bit less negative was earnings, and we'll show you a chart to show how that kind of came to be about. A lot has to do with taxes, but again, a lot has to do with companies are doing well out there. The economic environment is very strong for companies to do well with their earnings and drive that valuation picture and hopefully improve it a little bit more. Macroeconomic environment, any way you slice it, is a very, very strong economic environment from where we've been. Now, it may not be as strong as some people like, and some people may think that it should be stronger given where we came out of in 2009, but any way you slice it, it's still a very positive influence across the investment risk landscape. Qualitative, we saw a little bit deterioration. This has to more do with the Fed and a little bit of the rhetoric coming out of Washington. Again, we don't use political rhetoric as an investment indicator, but we are conscious of the fact that it does have an influence on investor sentiment. It does have an influence on how people see the world, how they feel about the market, and it can have an impact. So we think that environment has got a little bit negative, so we dropped that down by one, but still, as a very positive environment, we have very low rates. They may be rising here, which we think they will, but we're still at a very low rate. So what we're going to do is take a look at a few indicators we use and a few we don't. So some of these indicators that I'm going to show you are in the model and some of them aren't. And I'm not going to differentiate between the two. It's just so you know that every indicator I show you does not have to be in our model. So technical, talking about structure. And we're looking at what we're looking at here is the black lines, the S&P 500, so upward to the right. And this orange colored line here is consumer cyclicals divided by consumer staples in performance. What are we trying to get here is it measures investor sentiment. Are investors bullish on the market? Do they think that the market's going to go up and they want to take risk? And when they historically have thought that, they've bought cyclicals, consumer cyclicals. Think things you don't need to buy. Think Harley Davidson. Think RVs. Think Coca-Cola, things you don't need to buy. Compared to a staples, which are things you need to buy no matter how well you're feeling. You need to buy toothpaste, you need to buy toilet paper, you need to buy shampoo, you need to buy soap. So when investors are really bullish on the market and their sentiment's up, they tend to go more into consumer cyclicals and they outperform those traditional safe havens consumer staples. So what we like to see is this line going up and to the right. And what we see right here, it is. So it has been for a while going up and to the right. So investors are investing in the right part of the market. They're investing in the cyclical part of the market. So they feel good about future expectations of stock prices. They're bullish on the market. So from a structure standpoint, that is very healthy for the market. That's one thing that's leaning positive on the technical indicator. Next thing we're going to look at is reversion. So this is what we commonly refer to as the fear index, the VIX. You may have heard that. What it really is CBOE, VIX Volatility Index. I mean, got this going back to 1990 thanks to macrotrends.net. Great website over there with lots of interesting, good data. And what we're looking at here is the VIX going back in time. Recessions that we know about are in the shaded. So what we see is that there's lots of periods where there's very subdued VIX, so down by 15, 20, and then there's the spikes subdued. And this is what we call a contra-indicator. So what this means is when investors are complacent, which is down here low in this red circle where they have been for a while here, that is a negative on this indicator. Investors aren't worried about risk too much. That means they're taking too much risk in their portfolio and they're not worried about it. When it spikes, that's when you want to invest. Think about the old JP Morgan adage. When do you want to invest? When there's blood in the streets. When is there blood in the streets? When the VIX is up at 80, 70. That's when everybody's scared to death that the market's going to go over the tank and we're never going to invest again. That's when you want to invest. So that would be a positive for this market. So what we've seen here is that we are returning to a more normal state. Investors have been very complacent recently with risk, and this has been flashing negative here. It's been at a too low. Investors are too complacent about risk. And what we've seen here is this little jump up, coming up right here, in the last few months, and you see a lot of investors saying, well, this is bad for the market, this is nervous, this is pretending to something bad. Really, it's just a return to normalcy. If you look back in time, it's been artificially low during this time period. And we've seen bouts of this before, and it takes a while for that to kind of work its way out through the market. So we don't think this is flashing negative yet. Actually, this is kind of giving us a more positive outlook on the market, saying, listen, it's getting a little bit better out there. Investors are starting to think about risk a little bit more, are taking it into account, and we like to see that. So this is what we call a contra indicator. And this is a good example of recency bias, where everybody's saying that, we want to go back to here. We don't want to go back to here. We don't want investors to be that complacent. We want them to be worried about risk, because that's the normal state of the market. The last technical chart I'm going to show you is my kind of go-to chart. If someone asked me, about a stock, about a market, in one chart I had to really look at, this would be what it is. The top here is RSI, Relative Strength Index, and this just looks for overbought, oversold conditions. So again, this is why we're looking on those reversion charts. Is there a turning point in the market? Historically, when markets have been above 70, it's a good time to sell, and when it's below 20, it's a good time to buy. So we see the market right now, it's right in the middle. So again, not too hot, not too cold, a neutral indicator, very good. The really positive technical chart is right here, and this is the long-term S&P on a weekly basis. This blue line right here is the 50-day moving 50-week moving average, because it's a weekly chart. And what we see is that historically, we're looking for breaks in this. This means that there's a change in the market in terms of the indicator. So as long as this support holds and it kind of goes upward and to the right, this indicator will flash positive in our risk model. So what we're looking for is that not so much going above or how much above this line is, as long as it doesn't go below and it still provides support for the market. And what we're seeing is very strong support for the market, upwards to the right on a long-term basis. Some of the shorter-term charts have broken through some moving averages. We tend not to look at those too much. Those get you whipsawed, more day traders, computers, and algorithms trading. We don't play that game. We can't win at that game. What we can do is take advantage of them kind of overstepping their trading. And when they kind of whipsaw the market, we're going to take advantage of it. Over the longer term, we're still very positive on a technical picture. The last piece of this is the MACD, which is a shorter term moving average compared to a longer term moving average. For those who aren't too interested in it, what it means is if the black line goes to the red line, that's negative. When the black line goes to the red line, that's positive. So we saw a break in the market in the MACD indicator in February, not the total model, just this one indicator. So it should be flashing negative saying, hey, warning signs. And this is why when we talked about a model before, we said we saw some weakened technicals, and we have, but we haven't seen a total break in the market yet. So that's kind of an overview of the technical picture. Again, still positive, but weakened. So let's look at valuation. On the valuation, we use multiple indicators, but what we're looking at here is we talked about is earnings. So these are earnings estimates put together by the S&P. Howard Silverblatt has tons of data out there, and he puts this together. And these are what all the analysts out there expect the S&P 500 to earn for 2018. So as of 3/31, 2017, they expected the S&P to earn, little under $147. And you kind of see it came down, which is a normal state, which usually happens. They get overexcited, think they're going to earn too much, and they kind of walk down their estimates. Then you see this big break right here. Really starting in September, you saw a little bit of uptick, which is good. Then you saw this really large uptick here. A lot of this has to do with the tax law that passed. It does benefit corporations. It was designed to benefit corporations. We can argue whether it's fair or not, but what it was designed to do was to benefit corporations, and it has. And that was reflected in the earnings numbers. What it's also doing is that's just a small piece of this. We are seeing companies come in with better and stronger earnings. We do need to see follow through this. Again, so the tax benefit's great. It's a one-time event. It's great to see the economy going as strong. It's great to see companies doing this in terms of an investment standpoint, but we need to see follow through. But from what we're observing in the marketplace right now, we do see strength in earnings. And this is, again, improving the valuation picture. Not enough to make it positive, but improving. So from a total valuation picture, we're still negative. So we're positive on technicals, negative on valuation, and then we go to economic. And any way we slice it, we're very strong economic background here. It's very strong, growing global economy. And again, what we've talked about before is the data doesn't really match the rhetoric out there. You hear a lot about how there's trade wars, there's tariffs, no one's going to be trading anymore, the economy's going to be slowing down. When we look at the data, and we look at the data that kind of pretends what's going on in the future, we just don't see it. So what we're doing here is looking at a chart from our friends at JP Morgan. They put together this guide to the markets every quarter, and it's amazing. It's 80 pages chock full of data, and it's great. And what they allow us to do is to kind of present it to our clients, which is great. So what we're looking at here is a Global Purchasing Managers Index. So what this is, it's called a diffusion index. And what it means is it asks certain companies to say, is your company getting better, staying the same, or getting worse? So again, better, same, worse. And they ask a whole bunch of questions on that. So again, it's a good indicator of what's happening. It's not an indicator of what's happened in the past. It's not like a GDP number where it just tells you what happened. This is really getting to what companies are thinking and what they're planning out for the next 3 months, 6 months to a year. And we have global, which is the whole entire world, developed markets, emerging markets, and all the countries listed here. They don't let us show the numbers, but they do let us show the colors. So what green means, it means the PMI is above 50. If it's yellow, it's right around 50. If it's red, it's below 50. And what that means is anything above 50 means the economy is expanding. That adding up all those surveys from all those companies, and the economy is expanding, and that's what historically it's seen. So what we look around the economy from February, amazing, everybody's in expansion. There's not one negative country out there on February. Everybody's expanding. So we're seeing this strong global economic activity out there. The data is telling us that it's still a good environment to be investing, yet we're hearing a lot of negative rhetoric in the press. So again, the data doesn't match the rhetoric, which is why we use these multiple factor models to make sure that we get the entire picture. We're just not looking at one piece. Because if you just turn on, say Fox News or MSNBC, you may get a different picture of the economy than what's actually happening out there. So we always want to rely on the data. And from the economic background, we're seeing a very strong economic backdrop. And one here is the economic, again, from our friends at JP Morgan. And what we're looking at here is the unemployment rate, which is this dark line right here. So again, going back to 1970, and wage growth, this is blue line. So when we look at the economy, a lot of questions we get is, we don't see wage growth. My neighbor is not seeing any wage growth. I'm not seeing any wage growth. Where is this wage growth? If the economy is going so strong, where is this wage growth? And we are seeing a little bit of it. It's in pockets. And again, we're looking at averages here. So it may not be wage growth in your industry. It may not be wage growth in your geography. But overall, the average, we're seeing strong wage growth in the U.S., about 2.5%. Again, we'd love to see that stronger, but that's where we are right now. And again, historically, the relationship has been that as the unemployment rate comes down, wage growth goes up, and then we get inflation. And that's what a lot of people are worried about now, including us. We do think there's a risk out there that inflation jumps. But what we're looking at this, and what we like this chart for is, you look past history, that this 50-year average of 4.2 on wage growth, that's when you really start to see things happen. That's when you start to see inflation. And you can see right here that even though it's strong at 2.5, we still have a little ways to get up to the traditional average of 4.1%. So what this means is when we're looking at companies, we're looking at the investment environment, that wage growth is good. At some point, wage growth will be bad for companies. And I'm talking about companies in an investment environment, not the economy. Wage growth is bad for companies. It hurts their costs, it brings down their earnings, and it hurts stock prices. What this gap says to me and says to me here is that we do have some room here, that wages can still grow from here before they start negatively impacting companies. So again, we do think this matters at some point, but for right now, we want to continue to see strong wage growth. We're seeing jobs being created, wages are growing, and until this really kind of gets up here, we're happy seeing this wage growth. So we're just not there yet. We're watching it closely, but we just aren't there yet. So given all that, let's kind of sum up where we are in the investment environment. From the technical picture, like we talked about, we're weakened but not broken. We saw some negative turns in some of our technical indicators, but that long-term chart is really posting strong gains. We have seen return of volatility, which we think is a good thing. It allows us to take advantage of dislocations in the market. Again, buy low, sell high. You really can't do that if there's no volatility. So we kind of like to see this volatility return as it's a more normal state in the markets. Valuations, they're getting better as we saw with the earnings, poised to rise. We need to see the follow-through. Company's about halfway done reporting now, and so far we are meeting those earnings expectations. So we just have to make sure the rest of the companies that report, and still to see continued strength in that. Again, given that and the recent price weakness, we've seen an improvement in the valuation picture. We still think EM, which emerging markets and developed, which is international, offer better value than the US. And I'll show you a chart that kind of goes through that. We also, the macroeconomic environment, the expansion continues. And given this expansion and given what we're seeing in controlled, subdued inflation, that we do think rates are headed higher. And quite honestly, the Fed said rates are headed higher. So I don't know why investors, and I'll show you a chart that shows this, does not believe that the Fed's actually going to follow through in all their rate hikes. And we actually think they do. So I'm kind of looking at the investment environment. The big thing to me is that the last few years, and I'm talking pretty much, since 2010, it's been all about how much risk you're taking in the market. So you could basically just close your eyes, hold your nose, buy a risky asset, and you're doing all right. That's a great environment to be in. I don't think it lasts. I think going forward, it's going to be really more about where you take the risk. So it's not about how much risk you have in the portfolio. It's about where you're taking that risk. And if you're not conscious of where you're taking that risk, you could end up finding yourself in a hurricane. And that's where we think the environment is changing here. So let's see how our portfolios are positioned in this environment. This asset allocation is as of March 2018 and can change at any time, and maybe will. But again, as of March 2018, for our clients, we're neutral equities. But we are finding pockets of valuation support in international EM, so we would like to be overweight that and underweight the US, especially the large caps. We do have some good allocation to small caps. We see some of this value there, but we don't want to be overweight US equities, even though we do think they can still work here. We're not saying US equities are falling out of bed. We're not calling for a bear market. We're just giving with my client's risk budget, where do I want to take that risk? I would rather take it in a more fairly valued market like international EM than in the US. Fixed income, we do not like fixed income here. We do want to be underweight duration, and duration is just a measure of how much a price moves in your fixed income instrument when the rates go up by 1%, and we'll kind of go over a chart on that. Cash, we're neutral on. We don't think clients need to hold a lot of cash here, although as rates come up, cash may become more attractive here, but for right now, we don't think it's that attractive. Commodities, even given the recent price rise, we don't think it's a good investment right here, so we're underweight those. And where we're finding a lot of value right now is alternatives. We really think alternatives is a good way to kind of, again, hedge that risk from the hurricanes, and it will prevent you from going to a hurricane and keeping you in the more thunderstorm. And again, this is no change from last quarter, so the last time we presented, we have not changed our asset allocation. So I talked a little bit about international developed over US, and this is just one valuation measure. It's price to book, so it's the price of the market compared to the book value of the assets, and just adding up all the assets on the balance sheet to get a number. And what we're looking at here is done by S&P, and they do a monthly chart pack that comes out. And we look right here, this is the S&P 500 index. And it's a typical chart. So the lowest it's ever been is 1.64 for the past 15 years. The highest it's ever been is 3.45. The average is about 2.5. So where are we in the large cap space? We're almost at the highest we've ever been. So we're at the top of the valuation range. So if it's lower here, it's cheaper compared to historical. If it's higher, it's more expensive compared to historical. Where are we in the S&P 500? On the expensive side. Russell 2000, this is small caps US. Again, same story as the large cap US. Expensive, not as expensive in terms of how high it is, but still expensive. International, EFA, this is the international we talked about. Think about Europe, France, Japan, those type of countries. Much more right around the average. So again, the current one, which is this light blue here, it's 1.65, so a little bit below average. So again, a lot of room to expand here. Emerging markets, even better. It's right around the average too, 1.76. So what does this mean in terms of why we like international EM over US? Is better valuation support. They're closer to long-term historical averages of valuations. And we know from history that bull markets tend to go on from low valuations or average valuations, and bear markets always start at high valuations. So if you're farther away from that high point valuation, you're offering more value and more protection. So again, this is one reason why we do like international and EM over the US in terms of exposures. Doesn't mean we're zero weight US, we just like international EM a little bit better than the US here. Talk a little bit about fixed income, how we're underweight fixed income. These are long-term rates. We look right here. This is the Fed funds rate going back in time, back to 99, again from our friends in JP Morgan. And we start seeing in 2015, they started raising the rate until we get to right here. So this is where we are right now in this current environment, 1.63. And again, they don't set this rate. They just don't say, hey, it's 1.75 today. What they do is they indicate where they would like the rate to go and then execute transactions in the market to kind of keep that rate around. So even though they say they want 1.75, it's right around there. It's 1.63 according to JP Morgan as the end of first quarter 2018. And these blue line right here is what the Fed has saying that they're going to do. So as long as the data keeps coming in as they see it, and they expect to raise rates up to here over the next few years. This is what the market's pricing in. This is what the market thinks the Fed's going to be doing. So again, you notice this gap here. And when we see gaps, we always get nervous because what affects pricing more than anything? The unknown, the unexpected. What you don't think is going to happen happens, and then investors overreact both to the upside and the downside. So we think this setup here is looking very dim for fixed income. Again, given this gap we're seeing between what investors think the Fed's going to do and what the Fed's actually telling us they're going to do. That aside, they both think the Fed's raising rates. As the Fed raises rates, that hurts fixed income instruments. And what that's measured is called something called duration. And duration is a measure of how sensitive an asset is to a rise in interest rates. So think about it this way. The higher the duration, the bigger the price fall if rates rise, all else being equal. So given this environment, given that we expect rates to go up, given that the Fed's telling us the rates are going up, we don't want to be long duration. We don't want to be in mutual funds and indices that can't control the duration. And we look at the broad-based fixed income universe, it has a duration of like 6. We look at 10-year treasuries, they have a duration of 8, so they get impacted more. Something we like a lot here is floating rate bonds. They have a duration of 0. They're not going to be impacted by rates rising. They're actually going to take advantage of that and actually increase in price. So again, that's what we mean when we want to be underweight fixed income, lower duration, and find instruments that actually do better in this rising rate environment. This one talked about equities. So what we're looking at here is that we still believe equities can still work in the beginning of a rising rate environment. And you hear a lot about this from clients, and they say, well, we get rates are going up. We want to be underweight fixed income. But in that environment, I've always heard that equities get hurt. When rates go up, it causes a recession, equities get hurt. Not all the time. And again, a lot depends where you start from. It's not and where you are, it's where you start from, not where you end up. So what we're looking at here, another chart from JP Morgan, is a 10-year treasury yield, kind of as a proxy for the Fed funds rate, and a correlation, not a performance, a correlation. So what this means is that how 2 years out, if rates moved up or down, what was the correlation to equities? And what we're seeing here is this orange line right here, when the 10-year treasury yield, and right now it's right at 3%, is below 5%, there is a positive correlation between rates rising and equities. So what that means is as rates rise from a very low base, that's good. Equities still perform very well. Doesn't tell you how well they perform, but it says that as rates rise, they also went up 2 years out. That's a good thing. So again, this is one reason why we still think equities can work in a rising rate environment. We're not at this tipping point. And again, these are what we have to apply qualitative thinking to too. It's not a line in the sand. It's not that when 10-year treasuries hit 5%, we're going to go zero weight equities. It's just a good guide to say that historically speaking, we still have some room to run in the equity market here and that we don't want to be zero weight. We still think it's overvalued. We don't think you should put all your clients' money in there. But again, having a decent exposure to U.S. equities still makes sense here. And one asset class we love is alternatives. And again, I always get this. Why alternatives? The equity market's been like gangbusters since 2009. Fixed income's also performing well since I've been around. It's been performing well since the 80s. A lot depends on where you expect prices to be. It's not where they've been. It's great that the U.S. market has performed well since 2009, but what's it going to do going forward? And one way we used to judge that is expected returns. So again, what this is we're looking at a website from Research Affiliates. It's a public website. Anybody can go on it and just look at their expected returns. This is only one we use. We use multiple companies. We also use our own internal expectations of returns. But again, this gives you a good overview of where we stand. And again, there's not a lot of difference between these companies. That's kind of a dirty little secret. You can go to 20 different websites and you're pretty much going to get pretty similar return expectations. So what we're looking at here is all the asset classes. And what I really want to focus on right now is the U.S. So U.S. large. So think the S&P 500. Think the Apples of the world, the Googles, the Facebooks. This one company, research affiliates, which has been a long history, a lot of PhDs on the staff, really much predict that there'll be no return over the next 10 years if you hold large cap US equities. If you hold small, you get a little bit more return, but you get a little bit more volatility. If you hold the international, you have a little bit more return, but again, still not only 2%. If you look at EM, we're up over at 5%, but a lot more volatility. So without going into a lot of great detail, and if anybody wants to learn more about this, I'm happy to go through it with them. What we're seeing here is all these returns are really skewed to the lower left. What does that mean? Lower expected returns. So what we've seen historically in the market is not what we're going to see going forward. We've already earned the returns. We've already earned these big, large returns, so much the low-hanging fruit, that going forward over the next 10 years, we're not sure we're going to see those high returns. And investors have their own need requirements. They have those financial planning. They have those retirement needs. They need to earn a certain rate of return. Given traditional beta return, which is dependent on the US market, international market, fixed income going up, I don't think they're going to get there. And we look at that 60-40 portfolio here, it just doesn't look like there's a lot of return there. Now again, this is a confidence interval. So you can see here that it could be up here around 4, could be up here around 1.7 negative. So again, these aren't point estimates, they're more confidence ranges. But again, looking at all the data, it does not portend well for future equity prices. And just to give you an example, so that's the expected, what we've seen over the past 5 years. Again, we've seen US large deliver over 10%, small 10%. We don't think that's repeatable. Again, what goes up must come down. We do believe in mean reversion over here. We do think this comes down. So when we look out over the next 10 years, we're not so excited about being 100% in beta exposure, which means just exposed to the whims of the equity and fixed income market. We do think alternatives work here. So that's kind of what we're portfolio positioning. What I'm going to do is switch gears here a little bit, and we're going to talk about aligning your investment portfolio with your values. So this is our carbon light portfolio. So last webinar, I mentioned in passing, we have a carbon light solution during the CIO Corner webinar. And we got a lot of feedback about wanting to know more information about this. I think it resonates well with a lot of investors today. A lot of people are coming around to this, that they can provide an impact with their portfolio and actually want to invest their assets and align that with their values. So I thought it'd be beneficial to just take a few minutes, a few slides here, and just kind of go over how we can help you reduce fossil fuel exposure in your portfolio. So the first question we always get is, why divest? Or reduce fossil fuels in your portfolio. Why do this? Well, to do this, one, you want, again, like we've talked about, align your investments with your values. You believe in climate change. You believe that the environment's endangered here, and you want your money to do a little bit of benefit to that, to kind of help everybody. And also, people don't think about, too, a lot in this, is reduce financial risk of fossil fuels. So if we kind of look at ExxonMobil, kind of call it the boogeyman of the environmentalists, but it's a company. And the investors value the company based on future expected cash flows. ExxonMobil gets a lot of their future cash flows based on oil, fossil fuels they have in the ground. So imagine 10 years from now, we're 80% solar, 80% renewable energies, maybe wind. Is that oil still valuable in the ground? Is it worth the same amount as it was before? No. So there's a big financial risk that what you think that oil is worth in 10 years from now is not. And that's how investors value companies. So that's when you get this valuation risk where investors start to think about and say, listen, that oil really isn't worth $50, $60, $70 a barrel. It's worth 10 because no one's using oil anymore. It'd be a nice world if that's the case, and it could happen. So there is a financial risk of holding these fossil fuel companies. And the other question we get a lot too is, you know what? I believe in this. I want to make an impact, but I look at the news and we have glaciers melting, global warming. I have my portfolio here. What am I going to do? How can I help this? Well, I always go back to, people who really know this, and go back to South African Desmond Tutu, and I think his comment really sums it up. Do a little bit of good where you are. It's those little bits of good put together that overwhelm the world. So yes, your divestment, your reduction of carbon fuels may not have a direct impact on ExxonMobil, but you do it. Your neighbor does it. The person down the street does it. Someone else in California does it. And you get enough people doing all this little good together, put it together, and you really start affecting change in this world. And we've seen this throughout history where major movements have all started with people doing a little bit of good where they are in the world. So now we figure out why we want to divest fossil fuels. Let's figure out what we actually do and how we accomplish this. So we use something we call carbon footprinting to measure the output of your portfolio in terms of fossil fuels. And we always get, what is carbon footprinting? So carbon footprint of a fund, and again, we do this at the fund level, not at the individual security level, is calculated by tracking and measuring the greenhouse gas emissions. So again, there's companies out there, and what we use is SRI and South Pole Group to kind of calculate this. And the information is freely available. They have a website, you can go to it. They have majority of the funds out there. There are some that aren't listed there, but the majority are out there that you can get carbon data for. We really like this group because they're not a data company. They're a non-for-profit. They're doing this because they're passionate about it. They're not doing it to make money. They're not doing this because they want to sell you something. They're doing it because they really believe in this and they're very passionate about this environment and they want to get this data out there. So again, we use their data and they measure the greenhouse gas emission, the total greenhouse gas emission output of all these companies, add it up and give a score to every mutual fund they track out there. They don't do this for fixed income yet, and there's all kinds of technical reasons why the data is tough to find, so it's only for the equity space, but they give the majority of the funds a ranking. How much is the carbon footprint of Fund A? How much is the carbon footprint of Magellan? How much is the carbon footprint of the quality ETF factor that we use in our portfolios? And you can measure that. Again, this is expressed in tons per carbon exposure. This is carbon dioxide and equivalents. So again, it's a measurement of all the greenhouse gases out there. It's greenhouse gas emissions. And it's written as TCO2e is what you see out there a lot. And it's a total carbon dioxide and equivalent emissions. So why do we use carbon footprinting? Well, the big reason is it allows for portfolio comparison. It allows us to compare apples to apples. A lot of this is a client will come in and say, I have portfolio A. I want to reduce my carbon exposure. Traditionally, people would look at it and say, okay, let's sell some Exxon, or they have a higher weighting in energy companies, let's sell that. And it's really tough to say, how much impact do I really have? Well, with carbon footprinting, you can actually show, and I'll show you a chart that shows us the actual impact you have by making these transactions and what is your actual carbon footprint compared to benchmarks, other portfolios, to see what the impact was. It's quantifiable and measurable. Again, I always look at my investments. I want to be able to quantify what I'm doing. Am I having a positive impact? Am I having a negative impact? How do I measure it? And this carbon footprinting allows that to happen. And the big one, too, from an investment standpoint, it gives you ability to control for concentration risk. A lot of what happens, again, like we mentioned, is that I want to reduce my carbon footprint. Let's sell all my energy companies. I also don't like utilities. I'll sell all those. Then you start getting to a narrower and narrower niche of the market. So now that not only are you reducing carbon footprinting, you're also increasing the risk in your portfolio. So if you wanted a volatility of, say, 10%, you're a moderate investor, you don't want to take too much risk. By doing this, you may sneak more risk than you want into your portfolio, which may not help you meet your long-term investment goals. And again, it's great to reduce your carbon footprint, but if you can't meet your long-term investment goals, then there's no reason to reduce your carbon footprint. So let's talk a little bit about what our carbon light portfolio is and what our goal is. So when we look at to design portfolios, we always look at what's the goal? What are we trying to accomplish here? So pretty easy, reduce carbon footprint of assets. That's the easiest one. That's what we want to do. And we can show you, check, we've done that. The second thing is we want to maintain a similar risk profile to our standard risk models. Again, if a moderate investor comes into us and says, I would like to reduce my carbon exposure, we don't want to have to move them to a conservative model. We don't want to have to move them to aggressive because we've done a lot of work to figure out what is the right risk profile for you. We don't want to change it based on just one factor. So again, we want to be able to accomplish this while maintaining a similar risk profile. We also don't want to pay a lot for this. We know expenses eat into returns tremendously, and that compounds over time. So if you had to triple, quadruple your expenses, which we have had to do in the past, which is one reason why we took so long to implement this, was that we had to really pay a lot to get this type of exposure that we wanted. And once we took that expenses into account, it really didn't make sense from a long-term investment standpoint. And in the end, the biggest thing we want to do is maintain the ability to meet your financial goals. Again, we want to do this. We think it's the right thing to do, but we still have to be able to meet your financial goals. And I think what we've designed here, we've actually accomplished all four of these. So we're going to take a look at our moderate portfolio, our carbon light portfolio. We do have conservative versions, we have aggressive versions, and we have everything in between depending on individual clients' needs. But we're just going to take a moderate for time's sake. So what we're looking at here is, and this is as of December 31st, 2017, so it's not as updated, but we haven't really made any changes, so it's still very relevant, is we look at a typical moderate client would have 22% in fixed income, 34% in equity, US equity, 28% international equity. In the carbon light version, the portfolio that we're trying to reduce our carbon footprint, we see that we have the same asset class exposures. We still have 22% in fixed income. Excuse me. We still have 34% in US equity. No difference in the asset allocation. We look at our extrema score, and this is our score of how to measure total risk of the portfolio. And if you'd like to talk more about that, please feel free to call the office if you want to learn more about that. But we look at our typical moderate client, and as of December 31st, they scored about a 55 in this model. And that's a total risk in the portfolio on a scale from 0 to 100. We look at the carbon light version. By reducing the carbon footprint, we are actually able to reduce the risk, which is not always good. Again, we want to take the right amount of risk. So, lower risk is not necessarily good if it's not equivalent returns or higher. But again, in the ballpark, very similar. So it's a very small difference. Expenses we talked about. Unfortunately, we do have to raise the expense ratio a little bit looking at products out there. It does cost a little bit more to have this exposure, and it went up by a small 17 basis points. So again, a typical moderate client pays about 40 basis points in underlying investment fees. This is not our management fee. This is the products that we buy. And the carbon light moderate only pays about 58%. So a small little rise. So for this small changes, the small rise in fees, what are we able to accomplish? We are able to reduce our typical moderate client's carbon footprint by over 30%, a negative 34%. So typical moderate client per $1 million invested, and again, this is so we can compare portfolios to portfolios, apples to apples, has a footprint of 106. Carbon light moderate portfolio has a footprint of 70. So again, a huge reduction in your carbon footprint. And again, thinking about Desmond Tutu, do your small bit of good that helps change the world. So by reducing your carbon footprint, you can help others realize this major goal of helping the environment. So I think for those clients who want to align their investment values with their investment portfolio with their values, that this makes perfect sense from an environmental standpoint. It's something that's near and dear to my heart. It's something we've designed here and we're really proud of. And if anybody would like to learn more, you can please call the office anytime and we can discuss this. So before we go into questions, let's kind of wrap up here, talk about some final words, where we stand. So what are we looking at? So extended valuations are still a concern, but the global growth story does remain intact for now. Again, could change, but what we're seeing. We did see some weakened technicals, but not broke. We want to pay attention to where your risk exposure is coming from. And this is the big one. Again, it's not how much risk you're taking, it's where you're taking it. We really like international over US, and we like value over growth. We want to pay less for assets than more. Central banks have continued to intervene, and they're going to lead to market distortions. It's going to happen. You just have to accept it. The markets don't behave how I want them to behave. They behave, how investors behave, and central banks are, as much as I think they should be out of the marketplace, they're going to be in here for a while. So you want to be cautious reaching for yield. Again, don't go up there and chase those high income producing things that have a high exposure to rising rates. You may get hurt in the long run. So, all that income you got from that high rates gets killed as soon as rates go up and you lose it in price. Short duration, we like floating rate. We like some convertible bonds here. And again, have some inflation hedges. We're seeing small signs of inflation. That wage growth starts picking up. Inflation may come back. We really like some inflation hedges here, and besides equities. And especially remain overweight to alternatives. Again, we don't want to rely on a rising equity or bond market because we don't think the returns we've seen over the past 5-10 years are going to be the same returns we're going to see going forward. We still think they're going to be positive over 10 years, but they're not going to be as robust as we've seen. And in order to meet your financial needs, your retirement needs, your investment needs, you're really going to have to diversify among return streams, which means moving away from traditional equity and bond markets. So this is the Appendix A, what we've seen, our compliance disclosures that required from the SEC. And now I'm going to turn it over to Amanda to see if we have any questions out there.
Hi, Chris. Thanks so much. I just want to remind everybody to use the questions taskbar if you do want to submit your questions, but we do have a couple to start with. So, Chris, the first one I have here is, we are 9 years in on a bull market. I inherited about 500,000 2 years ago, and I have held off investing it in fear of a sell-off. But I've also missed out on the rising markets over the next 2 years. Any suggestions?
Talk about a very specific question. Very easy. Ask your advisor. Really find a good, strong advisor and ask them what to do. Again, everybody's perspective is different. Everybody's situation is different, and kind of depends what your goals are, what your risk tolerance is, what your risk profile is, what your financial situation is. It's not a question you can easily answer. I would say, generically speaking, that given you shouldn't use what's happened in the past 2 years to judge how you're doing going forward. You really should look at what's your needs, what is most likely to happen in the next 2 years. What you don't want to do, and again, what I'm sure this person is trying to avoid is, oh, the market's going to sell off and I'm going to invest, right before it does that. We don't see a market sell off right here. You don't want to invest in hurricanes, and we don't see a hurricane. But again, the best advice I can give, talk to your advisor and get the right investment, long-term investment program, and base your investments on that, not what's happened in the short term in the terms of performance.
Just to expand on what you just said, how do you know if it's a hurricane and not a thunderstorm?
Good question. You never know for certain, 100% certainty, but you can increase the odds. And that's what we're trying to do with our risk model. We're trying to observe the risk we're seeing in the marketplace. And what we're doing is, if you think about it, if you knew nothing, there's 50% chance you're in a hurricane, 50% chance you're in a thunderstorm. By putting together all these factors that have worked in the past, these indicators that provide insight into how much risk is in the market, you can kind of change those odds in your favor and see where those odds are going. So, it's like 70% that we're in a hurricane. Then we know in hurricanes. So that's what we're trying to do. We're not trying to predict with 100% certainty where we are. We're just trying to equate how much risk is in the marketplace, get the odds. Are we more likely in a hurricane or a thunderstorm? And again, use multiple lenses. Don't focus on one data point, and take a longer-term view.
The next question I have is, how does the performance data of the Carbon Light portfolio compare to Stonehearth's regular portfolio?
We don't talk about performance on this to the SEC, so again, I get very nervous about talking about any performance at all. So again, if you have a question on performance, please give the office a call. Happy to talk to you in person, but on a call that's open to the public like this, we don't talk about performance.
Yep, we can certainly reach out to that person after the end of the webinar. The next question I have is, if the investment environment is volatile, how do you go about protecting assets?
The first line of defense is diversified, right? Have a very diversified portfolio that helps with that volatility. And the second thing is, have the right amount of volatility in your portfolio. And that's what we really strive to do here at Stonehearth every day, day in, day out with clients. Really understand how much volatility they need, how much volatility they can stand from a financial strength perspective, but also much more from, a sentiment standpoint. How much can they tolerate in terms of their personality, how much risk? So again, first line is diversification. Second line is take the right amount of risk. Make sure that when that volatility hits, you don't have an overly risky portfolio, because what we find throughout history is that investors tend to make those decisions that hurt their portfolio in those types of environments when they've taken too much risk than they really expected. In other words, the portfolio went down a lot more than they thought, and they make trades that may not benefit them for the longer term. We use an individual software called Riskstreamer that really helps kind of identify how much risk you are taking in the portfolio, and really paints a good picture for a client to understand how much risk is in their portfolio and how much they're taking and how much they really want to take.
The next question is, why do you choose the indicators that you do?
Yes, again, easiest one, they work. So throughout history, I've been in the industry for over 20 years. I've used similar types of indicators throughout my career. And again, just studying history, what works. So one, it has to work. Two, we have to understand why it works. I've seen so many models out there that just put together like 70 different indicators, and you ask them, what does indicator mean? I don't know, it worked. Well, no, you have to understand why it works. Because if you don't understand why it works, have belief in the indicators, then you're not going to be able to rely on them to make good, sound investment decisions. Third, they have to have economic standing, right? So they have to have a reason why they work. So when we look at PMI, that's looking at purchasing managers, what they're doing, looking out at the future. Are they ordering more goods So that has an economic value. That makes sense. If in terms of GDP, is that a judge for how much risk is in the market? No, it's looking back. It's what's happened. It doesn't tell me anything about the future. So it would not make a good. It doesn't have an economic basis for predicting what's going to happen in the future or helping guide what's going to happen in terms of risk in the space. So again, understand what we're investing in. It has to work, and it has to have sound economic theory.
Chris, how can you be so positive on the market given the recent price performance?
Again, it really has to do with recency bias, and it's a behavioral trait that we've seen throughout with investors, that they put more weight in what's happened in the short term than the long term. So again, they've seen this recent price weakness, and they tend to think that what they've seen in the short term is going to continue and keep continuing. But we know that's not necessarily the case. It could go down from here. It could go up from here. It could stay the same from here. We just don't know. What we can do is kind of rely on the data, see how much risk in the marketplace, how does that look compared to historical numbers, and where do we stand on that risk spectrum. So given where we stand on the risk spectrum, we don't see that short-term price performance having an impact on the long-term price performance of securities. We also want to take a longer-term view and make sure that we're understanding how much risk we're taking in the portfolio. So again, if you're at the right risk level, you use the right data to understand how much risk is in the marketplace, then you don't have to worry about what the market's done over the past month, past 2 months to influence your investment decisions.
Chris, in respect of everyone's time, I think I'm just going to end here with 2 more questions, and if we didn't get to yours, we will certainly reach out at the end of the webinar. Sure. The first one is, what is your best investment idea right now?
I always get asked this, and even at cocktails parties, it's kind of the old E.F. Hutton. What's E.F. Hutton saying for those people who remember who E.F. Hutton is? No one really does anymore. My best investment advice is to really just invest in diversified portfolio. And if you don't know what to invest in, then have someone help you. That's the best thing. Start saving now. Invest more. That's another good advice. Just invest in something because it will help you meet your financial goals. We look at a client's total investment picture. We look at from a portfolio perspective. So not one part of portfolio is better than the other. So I would never tell anybody to invest in a certain asset class or a certain stock or anything like that. I would have clients get the right risk level and invest in an entire diversified portfolio. So I tend not to give answers in terms of say what's the best part of the marketplace, because it depends on your situation, on your risk level, and what your individual and family goals are for your portfolio.
And the last question here before we end the webinar is, are we going to have a trade war?
I wish I knew. It's interesting. Again, I think it is affecting the market from a sentiment standpoint, not from a data standpoint. We're not seeing it come through the data. The rhetoric is definitely getting hotter. It's cooled down a little bit over the past few days, but I think because there's other things going on that kind of change what people are focusing on in the press. And I do think the press has very myopic views. They go from one subject to another, and they probably will come back to this, but they're finding more interesting things to talk about now. And I'm not sure it's actually news, but they're finding interesting things to talk about in terms of what they think is interesting. So in terms of the trade war, in the end, my personal opinion is that they don't have a trade war. I think that there are grown-ups in the room, and that eventually people will realize that global trade is good for most people. Doesn't mean that it's good for everybody. It will dislocate workers. It will dislocate people. It will dislocate jobs. It's going to have a negative impact on certain pieces of the economy, certain geographies, certain segments of the population. It's a necessary evil. There's no win-win-win-win situation that everybody wants out there. Someone has to lose. We just think that giving a trade war, more people lose than win, and the grown-ups in the room will realize that and say, let's back away here and let's make some deals, still keep global trade, which has benefited society throughout history, and kind of keep going on the path we're going with a few minor changes here and there. Again, I do think we have to remember what we're dealing with. Now we're dealing with someone in the White House who's a little bit different than a politician. He comes from the real estate, and it's more transactional. So some of what we've heard him say is just trying to get a deal done. And it's a little bit different than what we've seen. I'm not saying it's better or worse. It's just different than what we've seen from politicians in the past.
Chris, thank you so much for joining us today for this quarterly update. I just want to remind everybody that Chris's CIO's Corner is actually a part of our 2018 webinar campaign, and you can find that at our website at www.stonehearthcapital.com. We do record all of our webinars. Hopefully we'll have this one up by the end of today. If you'd like to sign up for our May webinar, it will be with our Senior Financial Advisor, David Giuliano, and it is Strategies to Optimize Social Security Benefits. That will be held on Thursday, May 24th at 10 a.m. So make sure you go ahead and check that out and sign up. You can also see the entire webinar calendar for the rest of this year as well. So if there's any topics that interest you, please go ahead and sign up, and we hope that you guys join us for one of those as well. Thanks again, Chris.
Thank you, everybody. See you next
All
quarter.
right, have a nice day. Bye-bye.